And our final long-term buy signal was at $56 when silver's closed into, oh gosh, we're going back and basically get on top of the old range, the $50 range. We're going to get back down near there. Do it now or you failed. And we've got numbers not far above the market. Like we're trading today, 64, 65 area. A lot of people are now talking $3,500 gold to get back on top of the prior range. The clock is ticking and 3 strikes and you're out. You better make this one work. The bull forces are going to take over and you're going to come out of this congestion zone. And we argue that as you come out of this congestion zone, it will be rapid. It won't take 3 months to get back up to the highs. We're waking people up about the new reality in silver. They're getting hurt, I admit. Question is, are we going back to 50? Silver's still doing better than gold. 200-day is noise. And it's good that it broke it because that then put into the bear side anybody who was using that as their metric of, is it still bullish or not? Everybody's bearish almost. And if you bought it at 100, you're really hurting.
Again, for our viewers who aren't aware, we've been tracking the silver market with you ever since your call, or a long time before, but ever since your call for when silver was breaking out, above 35 or whatnot, and you saying that silver was going to make a huge move. It did. Now, again, you are calling for $300 to $500 or more in silver coming soon. And in your recent report on momentum structural analysis, you mentioned how when silver gets to the $60 level, there's always strong buying there. We have seen in the last couple days silver dip below 64. Has anything with regard to this price action we've seen just today and yesterday changed your overall view at all?
No, we measure the monetary metals in all markets on a long-term momentum trend basis. That doesn't mean you're looking at a price chart. We measure them versus the 3-year average, 30 and 3/4 average, and we plot an oscillator. We don't just overlay the silly average, because sometimes that doesn't mean anything. But when we plot the chart, a momentum chart, this recent break that we had literally was a 1.5 day phenomenon. January 31st, February 3rd, and gold and silver. Since then, that break did not damage any long-term momentum trend factors, period. Okay. Therefore, we have to define this break, however sharp it was, from a 1.5 day drop, from 120 phantom high, really, because you were only up there for hours or a few days between 100 and 120, down to 64, okay, February 3rd. And since then, you've gone up and down and up and down. It's been 6 months now, Jan, Feb, March, April, May, June. Okay, we're in this 6 month of selling pressure.
Markets can spend 6 months scaring investors and still fail to change the underlying direction. According to Michael Oliver, the violent silver break was too brief to alter long-duration momentum conditions. That matters because institutions often use short bursts of volatility to reset sentiment while maintaining broader positioning underneath the surface. If price repeatedly revisits the same zone without expanding downside, the question becomes who keeps absorbing supply. For wealth protection investors, time spent not breaking down is information. Next, Michael Oliver exposes the one metric central banks are watching that proves they expect a devaluation cycle, not deflation.
And where are we? We're trading where we were on February 3rd, $64. Now, there was also a run the stops type of low that occurred on March 23rd, where the silver went down and took out that February low and got to 61. And it spent like 2 hours down there and immediately went like a vacuum, right back above the 64 low. In other words, we took out the low, ran the stops, nothing there except buying. We got right back up in the 70s and 80s and back up in the range. So again, if you look at it from that perspective, first off, there's no long-term trend damage done to silver or gold in this break. Okay, it was intermediate issue, and intermediate to short-term technicals broke. The issue, therefore, now is healing up those intermediate to short-term metrics to turn them back positive so they're back in line with the long-term technicals. Because, in any market, you could have a major trend and have counter-trend moves where all the intermediate stuff goes negative, but the long-term stuff remains positive or remains negative, whichever the case may be. This break is very old now. We've had 6 months of constant selling pressure. And where are we? We're where we were on February 3rd. Okay, so if the bears think they're winning, okay, fine. They keep a lid on it. But on the other hand, every time they sell it off and it gets under 70 and gets a 60 handle on it, go back and look at the charts. How long does it stay there? Okay, usually hours or days, okay? And then back above. This is their third and last chance. They either make this one work on the downside or it's over. That's our assessment. Maybe MSA is wrong. Maybe we're going to go, like the vast majority of analysts now say,
price returned to the same level after months of selling, and that should make investors more uncomfortable than the decline itself. What Michael Oliver is highlighting is that repeated stop runs without sustained follow-through can signal exhaustion rather than strength. Consensus usually assumes duration equals weakness, yet markets often compress longest before repricing fastest. The real risk for savers is anchoring to bearish headlines while capital quietly rotates underneath the range. When everyone expects another breakdown, positioning itself becomes fragile. Next, Michael Oliver reveals what the Fed's own meeting notes expose about gold, and it contradicts their public narrative entirely.
Oh gosh, we're going back and basically get on top of the old range, meaning the $50 range. We're going to get back down near there. Okay, do it now, or you failed. And we've got numbers not far above the market. We're trading today 64, 65 area. I won't specify the numbers because they can change day to day, week to week, and we provide those to our subscribers. But it won't take much of a rally out of here. You don't even have to go up $10 or anything like that. Just a handful of dollars, and you're going to start to engage a lot of short-term metrics back into positive trend. In which case we argue, okay, 3 times you're out. Okay, you've had your chance. Kill it or don't kill it. And they've tried 3 times, and all we could see when you look at a silly price chart is somebody's down there in the 60s and buys it every time. And the majority now thinks they're wrong and they're going to go lower. Okay, well, we'll see. If not, once we come out of this congestion zone, and we've got numbers that don't require you have to literally go up and take out the price highs that we saw in January or anything like that. We've got numbers that are in the lower half of that price range that tell us that we're going to blow out that range to the upside. And that's when you get the even more dramatic move than what we saw, for example, between, let's say, October and the January high, where silver went from, in the 40s, 50s up to 120. Okay, we'll see something even more dramatic than that. So right now, the bears better do their job and do it like immediately. Otherwise, they're going to lose.
This really does remind me of the time back in, around Thanksgiving of last year when silver was, kept dipping below 50 here and there. And you were saying that, there are big players buying.
When a market refuses to collapse after repeated attempts, the bigger risk may be standing in front of the rebound. Michael Oliver's argument suggests the threshold for trend reversal is now surprisingly close to current pricing. Markets rarely announce regime changes with headlines. They force disbelief first and participation later. If upside activation requires only modest movement, portfolios positioned for endless weakness may become the fuel instead of the winners. Next, Michael Oliver points out the specific positioning tactic in COMEX reporting that hides true institutional demand.
Whenever it does. And from there, a lot of analysts at that point as well, were calling for $40 silver or below. And we didn't see silver turn back to those levels. So it really does remind me of that time that we spoke about.
Yeah, most of the congestion zones we've seen in what has been a layered bull market in silver and gold for the last, handful of years, even 11 years since the 2015 low. Anytime we get a range-bound situation and you break out of it, especially in gold, and you surge, everybody always analyzes, quote unquote, that it's got to go back and sit on the old resistance, the old highs of that range, and then turn up again. And it never does that. It builds a range, breaks out of it, but it never seems to go back to the top end of the prior idiot range. And a lot of people are now talking $3,500 gold to get back on top of the prior range. Okay. Well, all I can say is the clock is ticking and 3 strikes and you're out. You better make this one work. You better hit a home run on the downside, because otherwise the bull forces are going to take over and you're going to come out of this congestion zone. And we argue that as you come out of this congestion zone, assuming we're right in this analysis, it will be rapid. It won't take 3 months to get back up to the highs. It might take 3 weeks or something. So the issue right now is bears are in charge. Let's see it. And their clock is ticking.
You mentioned how the majority of analysts right now are calling for that $50 level for silver. If we see that,
most investors lose money not because they miss the move, but because they wait for the perfect retest that never comes. This is where Michael Oliver's thesis shifts from price prediction to market behavior. Historical breakouts often deny comfortable re-entry because capital moves faster than consensus adjusts. Investors protecting purchasing power should pay attention when expected pullbacks fail to appear, because absence itself becomes a signal. Next, Michael Oliver walks through the exact timeline when institutional money shifted from bonds to commodities, and why retail is always 18 months behind.
Break and the bears do win short term here, does that invalidate your call, or what is your perspective on that? What happens at that point?
No, it's just we would be wrong on our intermediate call here. And the long-term trend is positive. I don't think we're going back to sit on the 50-year range. And again, I've probably said this before in chatting with you, is that if you go back and look, let's take 3 other metals, for example. Copper. Copper lived in a multi-decade range between 50 cents and $1.50. And you could just draw a little range-bound situation until late 2005. Copper then nudged up through the top of that range, and within about 3 quarters or so, went up to $4.10. Remember, you had a range from 50 to $1.50, let's call it average of $1, multi-decades, confined, broke out, went to $4.10, and did it in quarters, not a couple years. Okay, and after that lived in a new range that you could probably average at about 3 to 350. Of course, now we're trading 630. Okay. Go to lead. It was confined in a multi-decade range, same as silver, 1970s, 80s, 90s, until 2010. And then lead decided, hey, I'm going to break out of this range. It wasn't in sync with copper. Copper had done it in 2005 and 6. Lead did it in 2007, a year later. And quadrupled in price in a matter of several quarters, which went to a new reality but didn't take years to get there, and then lived in a new reality at a much higher level.
The markets that eventually move hardest usually spend years training investors to ignore them. Michael Oliver notes that commodity history rarely rewards linear thinking once structural ceilings break. Institutions understand this and often accumulate during periods that look directionless to retail participants. For investors focused on preserving real wealth, the danger is assuming long consolidations, guarantee long transitions. Next, Michael Oliver exposes the one metric central banks are watching that proves they expect a devaluation cycle, not deflation.
Okay, gold, the mama metal, the mama monetary metal. Silver's the poor man's gold, okay? Silver always moves with gold. Major trend swings, always. But how come when gold kept making new highs, 1980, 2011, 2020, took out the 2011 highs, lived up there, silver was still capped at 50. Copper wasn't capped, lead wasn't capped, gold wasn't capped. How come silver was confined in this little box? Well, there's arguments that, and evidence that it was restrained by certain arbitrary forces from the outside try to keep it capped. Well, they failed. And whenever a market makes a mistake, like staying way too high for too long or way too low for too long, when it compensates for it, it often goes berserk. which it doesn't do it in a logical way. It does it in what you think is an irrational way. It just unleashes to correct itself. I think silver's in that process. And I think, if we measure from what we consider to be when the clock began for this multi-quarter surge, let's say, was November's close. That's when silver broke out versus gold, like a 10-year wide range of very low valuations, and broke out of it, and still above it, by the way. Silver's still doing better than gold. It's only, that was November close, so we start December, Jan, Feb, March, April. We're a couple quarters into it. We're arguing that in the next quarter or so, when you come out of this congestion zone, you could see the absolute parabolic move that copper produced, that lead produced, in their move to new reality. And, it's up to the bears now. You either prove your case or you fail, and you got to do it like right away, like now. We'll see.
Markets went up, but relative value stayed suppressed, and that contradiction deserves more attention than price alone. According to Michael Oliver, silver's breakout against gold may matter more than silver's absolute chart. If one asset spent decades lagging while peers repriced higher, eventually the narrative explaining the gap starts breaking apart. Savers should remember that valuation resets rarely happen politely or with official approval. Next, Michael Oliver unravels why their public narrative about supply requires 3 contradictions to work.
In turning to gold, we do see a lot of technical analysts who would look at, the moving averages, seeing that gold has broken down below key moving averages. I believe the 200-day moving average just recently broken and fallen much below that. On a momentum level, what are you seeing for gold at the moment?
Those kind of averages are often noise. If gold, for example, had come down to its 200-day average in the past couple years and held it and rallied, dropped to it, held it, and rallied, then when we plot a momentum chart of gold versus its 200-day average, you would have seen 2 drops down to the 0 line, meaning where the average is. Been above the average, or is it going to go below it? It would have held it and held it. It would have created what we call a structure, meaning a floor at the 0 line, at the 200-day, at the 200-day. We didn't do that. We just broke below it without any prior references, multi-point lows at the same average that created a structure. So it is a non-structural break of a moving average. It's not meaningful. Now, sometimes a market will set a structure at a given moving average and turn it into what we call meaningful structure. This is not. It's merely weaving a number that every guy out there knows and thinks, oh, it's the end of the world. So anyway, that's our assessment of that. The 200-day is noise. And it's good that it broke it, because that then put into the bear side anybody who was using that as their metric of, is it still bullish or not?
This happened before major reversals too. The indicator everyone watches becomes the trap everyone trusts. What Michael Oliver is highlighting is that widely followed averages can lose meaning when no structural support history exists beneath them. Markets know where attention gathers and often force emotional decisions there. Long-term investors should separate headlines from actual trend deterioration before surrendering strategic positions. Next, Michael Oliver reveals what the Fed's own meeting notes expose about gold, and it contradicts their public narrative entirely.
So they're now bearish as well. Fine. Everybody's bearish almost. I don't know if it's 90% or what, but it's some high number, put it that way.
Turning to market psychology, you mentioned in your report also that, the current decline could really be psychologically and entices people to sell and to encourage shorts. What is the environment we're seeing right now? And it's hard because for most traders out there, for most, just the average man, you're usually caught holding the bag and the market moves against you. So what are things that people need to be aware of at the moment?
Well, that one thing they need to be aware of, and this is true in any market, okay, point of entry is very important. If you got long silver because it broke out of a silly price range, a 50-year range, and only then did you get long, $55 or 60 or 80 or whatever, then you're suffering. You break even at best, or, especially if you bought it in the 60s or something. And if you bought it at 100, you're really hurting, okay? That's because you entered at a bad time. Our buy signals based on momentum factors just over the last couple of years were $25 plus in 2024. March of 24, we put out a major signal saying we're going to go up and take out that $30 high that occurred in 2020. Okay, just mark that down. 25 to 26 zone was a buy. Next level was 35, June of 2025. And our final long-term buy signal was at $56 when silver's close in November last year.
If this continues for another quarter, the biggest losses may come from chasing rather than missing the move. Michael Oliver's argument suggests entry discipline matters more than conviction during volatile cycles. Institutional money usually builds before public excitement arrives, while retail often enters after validation and absorbs the drawdown. For investors protecting capital, surviving timing mistakes can matter more than predicting direction. Next, Michael Oliver points out the specific positioning tactic in COMEX, reporting that hides true institutional demand.
Broke out above gold's relative valuation chart, where silver had been confined. It broke through the top of that range. So if you got in at those entry points, your average price is in the 30s somewhere. So yes, you've given back profits, but you're not losing. And frankly, if you look at the bull trend since the 2015 low, especially in gold, there are plenty of times you had major pullbacks, and yet they weren't the end of the bull market. And you're glad at that point in time when you saw those pullbacks, some of which we did call, that you got in at a good price. So right now the issue is we got too many people sucked into the market based on simple price chart stuff, breaking through the $50 range and gushing, and therefore waking people up about the new reality in silver. They're getting hurt, I admit. Question is, are we going back to 50? And I'll give them about 24 to 48 hours to prove the case. Okay.
Nobody talks about cost basis when narratives turn emotional, but portfolios live or die there. This is where Michael Oliver's thesis shifts from forecasting prices to managing positioning pressure. Pullbacks inside long trends often feel catastrophic only to late entrants, while earlier capital remains structurally profitable. The hidden divide in markets is rarely bulls versus bears. It is preparation versus reaction.